Good morning, everyone. Welcome to this month's edition of our Fireside Chat. As per usual, before we get going, I just want to read out the disclaimer for everyone. This is for general purposes only. For specific information on client accounts, individual positions, and/or financial planning tactics, please schedule time and consult with your advisory team for specific recommendations. With that said, Shawn, let's get into it.
Hey, good morning, everyone. For those of you who don't know me, I'm Shawn, Chief Investment Officer at Knightbridge Capital, filling in for Jim Niddle in this installment of Prentice Wealth Management and Knightbridge Capital's Fireside Chat series. Joining me today is Bill Prentice, Managing Partner at Prentice Wealth Management, who will share his insights on an article to be published in the May edition of the Rochester Business Journal's annual Wealth Management supplement titled Embracing Market Volatility, A Path to Portfolio Resilience and Rational Investing. Welcome, Bill. Let's begin. Can you highlight the finer points of the article and what you would like to share with those listening?
Yeah, so there were a lot of questions on the volatility earlier this year. What I endeavored to do in submitting this article to the RBJ and their wealth management supplement was to address some of these concerns. As you and I both, I think, view this similarly, we've been through a few periods, I would say really one protractedly long period interrupted by the COVID pandemic, where market volatility has been extraordinarily low and returns have been very attractive. And when I say market returns, I'm specifically speaking to the domestic equity returns in the United States. And so this article endeavors to kind of zoom out, talk about things that we can address, how we can be intelligent in our investing, and also control our emotions. You know, there's the old axiom, and I think this frames it well, the old axiom of buy low, sell high. The reality is, and all the data points to this in terms of robust research, investors buy high and sell low. And it's often referred to as the behavior gap or the emotional gap. And that's what this article starts to address.
Great. You know, we talk about volatility, and most people hear the word volatility, and I think they think somewhat of a negative connotation. But to be honest with you, volatility kind of cuts both ways. And from our viewpoint as, asset managers and whatnot, we see volatility and how it can be positive. An example of that would be, volatility is the natural characteristic of dynamic markets. It's the interplay between supply and demand. It's investor sentiment. It's a whole host of broader macroeconomic factors that all fit into what move markets and whatnot. And while it sounds negative, it provides a lot of benefits, a lot of positive benefits. One of those benefits is it drives price discovery. It's a huge factor in driving price discovery. I'd argue that in chasing stocks in an up market, a lot of times you'll feel like I don't want to pay that extra premium or whatnot for the stock. It may continue to go up, but it likely is at some point going to pull back. If the work's done, and a lot of times from a due diligence perspective, we do have the work done, that gives us an opportunity to maybe step in, initiate a position, add to our current position at a much lower level. So that's where volatility can add a huge positive to how we kind of look at things. And I'd argue that over time, there are a ton of technical reasons for volatility, benefits to portfolios, and some of them are it benefits our ability to rebalance portfolios, provide entry, like I said, into wanted positions at favorable prices or at more favorable prices. And I'd add the one thing that probably we don't talk about as much: when there's a need to raise cash, you hope the volatility is working in your favor. It cuts again both ways, and it can act against you. But if it's positive at that moment, it can really be an enhancer when you're looking to raise cash.
Yeah, Shawn, those are all excellent points. Oftentimes we think about volatility only in the downside. And oftentimes, we're concerned with that just based on our clients' portfolios. We've often referred, and I've often referred to it in many ways as a healthy market needs to plow the field and rotate the crops, right? To go back to my country roots and farm analogy where we grew up in that area, crops can't be planted the same field over and over again. It robs the soil. And I think to use words that, are more akin to what you might say and how you might phrase it, we need changing market leadership, right? That's a healthy market. The same companies cannot drive the market forward. And one of the things we're getting to here later is perception around that. So, Shawn, technical reasons, active rebalancing, the time-honored tradition of buy low, sell high. How do we deal with that in our portfolios?
Yeah, so we're dealing with it right now. We've had a relatively strong start to 2024 in equity markets. We've exited some positions at higher levels or higher levels than we thought we'd see. From our perspective, we've got upside and downside risk on every portfolio, every active selection in our portfolios. And it's given us the opportunity to sell out at prices that we're comfortable with. Now, we're never going to find the perfect time to sell out a position. And I'd argue that the sell decision's well harder than the buy decision. I can buy stocks all day. I can always make a case for buying the stock that the thesis will play out and it takes time and all that. The sell decision is much harder, but it's a lot rewarding, a lot more fulfilling when you have a price target that's met and you look and you can't stress valuation or you can't stretch the earnings per share and you say, okay, now's the time that we want to sell the stock. Again, most of the time it will go higher, a little bit higher, we hope, not much higher. And then we also need to take those funds that we've taken from the sold asset and then try to find maybe a position that hasn't performed as well, or one where the investment thesis is hold, but the market's just not seeing it the way we're seeing it. And that's a good opportunity for us to kind of, again, like you said, take from somewhere that's done really well and find something that hasn't done as well, but has characteristics or positives that are likely to play out at some time in the future.
So excellent point, Shawn. So as you go through that, there are a few things that ring true to me that we talk about a lot, right? Have a plan that's disciplined and have rules around that plan so that you don't violate your own framework, right? And a lot of what investing is having a framework and a discipline you adhere to. So I do want to get into that in a little more detail because oftentimes investing, there's the old axiom, don't put all your eggs in one basket, right? That's the core, that's the basic principle of diversification. And although, diversification can do some to temper investor anxiety, what we want to make sure is that people can see their way through difficult times or volatile times. It's not necessarily a recession, although some of the recession talk is why I chose to author this paper, because there may be a recession. What I can say pretty much universally is there will be a recession at some point in the future. And we all need to be prepared for that. And we can't prepare for it after it happens. We need to be, the nature of prepared means before, right? So market volatility can always excite investor anxiety, and we're all emotional people. It's understandable. So the principle is spread investments across different asset classes, different sectors, and different geographies. Those tend to reduce risk in terms of the definitional aspect of risk reduction, but also it can enhance returns. And the enhanced return aspect generally comes from what Shawn was describing in terms of buy low, sell high, and having a framework to change the language slightly to sell high and buy low. In other words, find the changing market leadership. And at its core, again, it's don't put all your eggs in one basket. But most importantly, we go further. So diversification is sort of the bedrock principle. It's the foundation for which asset allocation is built on. And asset allocation, it goes further than simply don't put all your eggs in one basket, right? That's the basic tenet. So asset allocation came out of modern portfolio theory, which won a Nobel Prize about 40 years ago, almost at this point. The principles laid out by Harry Markowitz and his team basically found that there were mathematical relationships between asset classes that tend to endure over time. And we can use those mathematical relationships to develop stronger portfolios rather than just don't put all your eggs in one basket. Put the eggs in a thoughtful way in the right baskets so that the load is more balanced over time. In other words, you're more defended against downturns or inflation, there are other pieces being considered, right? So there's an old saying that if you love everything in your portfolio at the same time, that it's not diversified. I don't know who came up with that. I'd love to give them credit, but it's been floated around so many times in so many places that I have no idea who to attribute that statement to. So whoever it is, if they're listening, I apologize, but please make yourself known. Real simply, and I'll use a few stocks that are loved and unloved right now. In a diversified portfolio, you may own Coca-Cola, Nvidia, and Amazon. And if Coca-Cola is behaving like Nvidia and Amazon, there's something that's extraordinarily wrong with your portfolio. They should not behave the same. Amazon shouldn't behave Coca-Cola. Coca-Cola certainly shouldn't behave the same way as Nvidia. Now, they might all be going up at the same time, but they shouldn't be going up at the same speed. They're extraordinarily different companies. Shawn, I took a long time there. Is anything you want to add to that?
Well, no, and I'll further highlight that with another stock, and we'll get a little bit into stock, and we'll go back to where we really should be. But Nextera is a prime example. So the beginning of the year, Nextera sold off probably 10 or 12% start the year, while everything was running higher. Wasn't worried, and it's across the board in most of our active portfolios. The reason is that they're well positioned for what they do. They're going to be needed along with the rest of utilities and energy consumption as we move forward with this AI paradigm that's unfolding there. Mm-hmm. And if you look in March, the stock was in the 50s and it's now at 75. But it serves a purpose in our portfolio because it's less risky in NVIDIA. It's less risky than an Amazon, but it may be more risky than your average utility because it the both offense and defense that you want to see in a utility/energy company. But that's a prime example. The stock was not acting well in March. We looked at our thesis and said things are holding right now. The market just doesn't love Nextera or utilities right now. There was a lot of things going on with the Fed in terms of maybe not cutting as much, just trying to figure out what's going to happen from an interest rate policy. A lot of times that affects utilities, but we said from what we're looking and seeing, the rationale and thesis is not changing. So we're continuing to hold stock. We actually added a little bit to it, and now it's performed much better. But there's always going to be a name, 2, 3 in your portfolio that are not acting like the rest of the portfolio or like the market per se, but they have a reason to be in the portfolio. Unless you're in a straight growth or momentum kind of portfolio that, let's say a tech portfolio, you're almost always going to have a stock or a number of stocks that is not acting like maybe the stocks that are leading the market at the time. That's okay. That gives us that diversification. It also gives us that portfolio version and risk, the ability to handle risk better. And that's something that we always want to see in our portfolios. I don't want 85, 90% of the portfolio up and to the right. And that's to the time when I get a little bit nervous, to be honest with you. We want to see more of a mix of stocks that are working. Maybe 60 or 65% of the portfolio is working, but then there's that 30 to 35% that's not working. But at some point in the future, as long as the investment thesis holds, as long as the market moves from a leadership perspective, which is healthy, that those stocks will play out.
So, Shawn, thanks for that. I think another aspect that we want to get into and discuss a little bit is investor behavior, right? And emotions, and really get to the core of, how do investors handle emotion in the process?
People get emotional about their money. That's age old. How should investors think of emotions when it comes to money decisions?
Shawn, I'm really glad you brought that up. The money part of our job often tends to be the easier part of the job. And I can't say it more plainly. Money and emotions just don't mix. Unfortunately, we're all human, and we need to recognize our own shortcomings when it comes to emotions and our investments, or money in general, a financial plan even. And to some degree, in all of us, we are human. And I use the term human finance often. And we need to recognize that fear and greed are at play in all of us. Market gyrations can often trigger releases of dopamine, feelings of euphoria that stem from our limbic system, which also oversees our basic survival instincts, fight or flight in simple terms. Emotions cloud rational decision making, and it can lead us to chase returns by buying high, at or near market peaks, or sell low during difficult times and corrections fueled by fear. Most of these are surefire recipes to diminish the desired outcomes.
Yeah, and my guess is when a person's in an emotionally triggered state, they're probably, making not the best decisions. But, can we talk a little bit about that and, how you see that when you interact with clients and whatnot?
Yeah, absolutely. I wish, not that you're not an adequate stand-in, but I wish Jim were here for this because he's sort of our in-house expert on this stuff behaviorally. So I'll do my best. Investors would do well just to accept that volatility exists, that our emotions will be present, but stick to your plan, right? We talked about how good investing is: define a plan, do the work, and then set rules. And, good investment strategies should be part of a bigger financial plan. That financial plan should help you anchor to long-term goals, and you should have some confidence in getting to those goals by reviewing the plan. In other words, make sure it's on track, right? Am I going to get to my destination on time and safely? If you are, the plan's working, and it's just market volatility and gyrations that are ginning up unwanted emotions or irrational. And try to resist that. And oftentimes we can do that ourselves. There are cycles of emotion, and emotion starts to be triggered, and then as markets can get more volatile or sell-offs can happen, those emotions start to feed on each other, right? Negative begets negative. Ultimately, what we need is an investment plan that connects to a financial plan that has a high enough probability of success that we can see through, that we can ride out the good times and enjoy those, but see our ways through the bad times or the difficult times or the volatile times. Volatility doesn't always mean bad. And if I can stress this one point, aside from where I'm at right now in terms of our discussion, markets tend to sell off at least 10% annually. That's a long-term average. And we just haven't experienced that level of volatility for a very long period of time. And that should be the norm by which we start to understand volatility. If it's not happening, great, we're making money and the seas seem calm. But know that it should be happening and that's normal and healthy for markets, that intermediate volatility is present. And we should think about that in terms of our plan, in terms of our investing life, and really understand that. And that'll help us navigate markets probably, and it is my hope, with a bit more confidence, so we can avoid the missteps of emotional decision making, impulsive behavior, and oftentimes impulsive behavior can really compromise financial security. And that's ultimately the goal. How do you get to the end? How do you arrive, again, to use that language, how do you arrive on time and safely to destination, retirement, education, funding, whatever it may be?
So build a plan, stick to the plan, and be as rational as possible.
Absolutely. That is a perfect way to ramble was.
Well, no, you got a lot deeper, but it really does get down to the point that if we build the plan, stick to the plan, and we're rational, the plan takes care of itself, and success is the reward.
Spot on.
Moving on now, we're wrapping into our last area. There's a lot of talk the financial media. It's front and center every day, whether you go to CNBC, whether you go to Fox Business News, a whole host of different places. Your computer, your phone, there's a lot of financial media that's out there. How should investors, how should clients look at that in terms of the media and their portrayal of our financial markets?
Yeah, I mean, the volume of financial noise through the primary, I'll use the TV sources that you were alluding to. There's three basic business channels, and there's more coming, right? So you've got CNBC, which is probably well over half of the market share, Bloomberg, and Fox Business. And you get a different take on markets from all three. So we do pay attention to those. But we pay attention to those in many ways to hear not necessarily what they're saying, but what we might be receiving in terms of questions, right? Because those questions are often fueled by those media outlets. But then you've got Yahoo Finance. Yahoo Finance has a TV channel, and it's not terrible. It's not I'm not sanctioning them by any stretch. That's the legal disclaimer. But also, if you think about our phones, our connected life, today we're in a hyper-connected world. Investors are inundated with a constant stream of news, opinions, market commentary from all sources. I mean, it seems insane to me that people would go to TikTok, Facebook, Instagram. I'm missing some. Fill in whatever the verb day is and the hot new app is. But to go get investment information, many of these sources have no anchoring, no training, no actual experience with money and markets, and it can be dangerous. Staying informed can certainly be beneficial, but it's very important. And I would argue we are at the highest level of importance right now we probably ever have been. And it's essential to distinguish between meaningful insights and hearsay. Hearsay, those things can just distort perception, fuel emotional reactions. We all need to be discriminating and recognize that what's being covered by business outlets, and I'm going to use business outlets in air quotes, whatever source you're getting it from, we need to question that source. What are they trying to tell us? Their mode, right? The basic, and I'm not trying to be overly cynical, but they're trying to capture our imagination and attention. They need viewers or clicks or whatever it is. So assume there's a layer of sensationalism in all of the reporting. It could be in disguise to some degree, but they need you to tune in for whatever they're saying. And they need to provide some sizzle to the bacon. So let me give you one concrete example that I like to use a lot. All right. So if you don't think anything I'm saying is got any fact in it, let's talk about the last 30 years. So if we look at the last 30 years ending in July of 2023, and we all venture to guess, and we had to put a chip on a board for the best performing stock in the S&P 500. So we all have 500 shots, right? We put our stake on one of the stocks in the S&P 500. I don't think most people would guess the stock that was the best performing stock over that period of time. I would take really I would tie to that trade to use market language. It's Monster Beverage. Monster Beverage.
The old Hansen beverage.
I can't say it enough.
Yeah.
No one on the planet that I've ever asked this to comes up with Monster Beverage. They come up with the old stalwarts, Amazon, Netflix.
Which have all done really well. But I think before it became Monster Beverage, if I'm not mistaken, it was Altria.
It was.
Essentially Marlboro. Yeah.
So what I would argue, right, is where's the media?
Yeah.
Why is the media covering Monster Beverage that's besting in a fluids space, right? In a beverage space? Okay, their products, I guess, are good. I don't know if I've ever had one, but they've bested the tech stocks. I'm not advocating for Monster Beverage. I have no opinion on Monster Beverage. Let me be clear as an investment. But what I am suggesting is we all need to be extraordinarily discriminating, because if I flip on CNBC right now, I would venture a strong guess that they're covering Nvidia, Apple, Netflix, Amazon, something in that space, maybe Facebook or Meta now, Microsoft potentially, but you're not going to hear about Monster Beverage.
Yeah, I think when they reported their last earnings, CNBC spent about a minute on the stock. But yeah, they weren't talking about Monster Beverage, and they won't talk about anything non-tech related for a substantial amount of time until tech rolls over. And that's going to be a little too late. So we need to be ahead of that. That's what we talked about a lot in this call, is that we want to be ahead of things, try to understand when there's maybe going to be a turn in the leadership of the market. It's hard to call that, but it's not going to be NVIDIA forever. NVIDIA is going to have a lot harder competition going forward. They're going to have law of comparisons that start to play in the, 200% plus growth in the quarter, in the fiscal Q2 that's coming up for the next report versus last year. That gets hard. Margins. There will be competitors that come out. So there will be a whole host of that will impact it. And we do own NVIDIA in our Alpha Leaders portfolio. And almost all of our clients own it in one way, shape, or form if they own VTI, the Vanguard Total Market Index ETF, or if they own the SPY, which is the S&P 500. You own NVIDIA. It's part of the market. That said, there will be a point in time where the market, rotates and leadership goes onto a different sector or a different industry. And that's why we have to be out in front of these things and not get too tied to the specific stock. You can love the company, but you also have to realize that we don't want to fall in love with the stock.
Yeah, and there's an old saying, right? No one ever got hurt taking a profit.
No.
Right. So want to just really just kind of wrap up this media section, because we although I've lamented the media, I haven't the question naturally becomes, how do you navigate this? This incessant noise, the only way I can suggest it is to really develop a hypersensitive filter. Obviously, you want to anchor to reputable sources. The Wall Street Journal still tends to be a very good kind of middle of the road source. They leave most of the politics at bay and get to the data and get to the detail. The minute you sense, and this is the hyper filter, you start to find some hyperbole and the opinion starts to come in. I'd mute the sound, change the channel, or turn the page, move on. Their opinion should not be necessarily your opinion. You should find the data, find the information, but don't necessarily adopt their opinion. Filter and find your own way to your own opinion. The sensationalism is there to stir emotion, to compel you to your side or to another side. Oftentimes it's a negative, if you will. And, it can only serve to increase the probability of poor decision making, right? Oftentimes people will anchor. And this is really the danger of taking the opinion, is we suffer as humans for confirmation bias, all right? So confirmation bias is a fairly simple framework. Essentially, we look for sources that reinforce our opinions. We can see that in politics primarily, but it happens in decision-making at all levels. And if you want to buy Apple stock, you will tend to gravitate towards sources that are positive on Apple stock. And so the less data, the less rigorous and filtered information you receive, and the more opinion, positive or negative, you'll tend to minimize the negative and amplify the positive to the point where you're just going to get to your end conclusion. We do this in all sorts of levels. I could probably spend a half an hour on this piece alone. It happens in financial planning. It happens in spending, that we logically justify our outcomes and our actions. It's all over the place. And if you can really get good at recognizing your own behavioral bias, it'll make you better at a lot of different levels of decision making. But back to the regularly scheduled program. So look, just practice mindful consumption of this stuff. Be diverse in your news sources. Again, turn it off when it gets to opinion. But try to get different sources that either confirm the data, again, the data, not the opinion, confirm the data or deny it or come up with a more skeptical tone on the data, not the opinion, but the tone of it. Properly practice this framework and also recognizing your cognitive bias should provide investors a much more robust outcome, a better way to their thesis, and it should refine some of the process so that you can also then build a framework like we were talking about earlier, and you remove the emotion, right? It's not that Apple's a good or a bad. I mean, I don't know why I keep using Apple. I should be using Monster Beverage based on those comments earlier. It's not that it's a good or a bad company, but we need something to govern us on whether we push on the gas or we tap the brake, right? Apple's been an extraordinary company for 30 years. Will it be the same company in 30 years? I don't know. but I do know that the stock will go up and down over 30 years, and a framework will guide decision making along the way.
Very helpful, Bill. Just so everyone knows, I'll reframe it here that the articles in the Rochester Business Journal, the annual wealth management section that hits in May, I believe it's May 24th, and it's titled "Embracing Market Volatility: A Path to Portfolio Resilience and Rational Investing." Bill, we appreciate all the commentary and all the thoughts. We want to wish everyone a happy Memorial Day weekend as we approach that. And we'll talk to you soon and in the future.
Thanks, Shawn. Have a great long weekend. And thank you to all of our servicemen and women that take care of us and keep us safe. We appreciate it. We appreciate everyone that sacrificed the ultimate sacrifice for our freedom.